Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to answer a question or speak about a topic requested by one of our viewers, Thomas Walmsley, or I hope I'm pronouncing that properly. I apologize if I'm not. Was asking us to make a video about treaty shopping. Okay, so we're going to cover that subject here in the video today. So stick around. You're going to understand what treaty shopping is, how this can help you to decrease your withholding tax rates. I know I've been getting a lot of comments from people saying, hey, listen, they're concerned about the withholding taxes on, say, investments that they're making in the US. So we're just talking about how can you do corporate structures in order to reduce that. But then there's this other part, which is anti-treaty shopping rules that can come and bite you. So I'm going to cover a little bit about that, how you can understand it. I'll give you the pros, like, okay, if you do it right, here's what the benefits are in terms of reducing your withholding tax rates. But on the other hand, if you don't, what the consequences are. So before we dive into that, if you haven't already, please, I would really appreciate if you would smash the subscribe button, hit the notification bell. If you are at all interested in the subject of international tax planning, how to reduce your taxes to the lowest amount legally possible, hopefully as close to zero as possible, definitely let me know. We can help you with international company formation, opening bank accounts, the actual tax planning itself, asset protection, as well as getting residencies, citizenship, second passports, etc. You can book a call with me, clarity.fm/Michael Rosmer. There's a link below in the description, or check out our websites, offshorecitizen.net, offshorecapitalist.com. And by the way, if you like the video, please share it. All right, so let's talk about set the context here for what is treaty shopping all about. I'm going to use the US as a simple example. Okay, it's very common that you would say buy stocks in US companies. Okay. Now, if you as a foreigner buy stocks in US companies, let's just say you bought, I don't know, Bank of America as a simple example, okay? Or, AT&T. So either one of them pay high dividends, right? Maybe around 5%, depending on where you buy them, things like this. If you're sitting there and you're like, okay, great, I'm getting this dividend income. Well, the problem is that dividend income is subject to withholding tax in the US, and the default withholding rate is 30%, okay? So, I don't know, maybe you've invested a fairly sizable amount and, your dividends are equal to 100 grand. All right, well, 30% of that, the IRS is going to take from you, okay? So that's not so good, right? It really kind of decreases the competitiveness of that investment, and you're thinking, well, maybe I shouldn't do that. And by the way, there is withholding taxes on dividends, on interest, on royalties, etc. So what do we do? Well, one way to deal with this would be, rather than say me doing the investment, or even my company do the investment, to look at, hey, what are the tax treaties that could allow me to reduce it? So let's use a simple example. If the UK, somebody from the UK was making an investment, under the tax treaty, you would have a 5% withholding tax on dividends, okay? So you're like, okay, great, 5%, that's pretty reasonable, right? A lot less than 30%. So, maybe it's worth it now. You can handle that 30%, or that 5%, sorry. But, what if you don't live there, right? Well, what you could do is you could, in theory, form a company in UK, right? And the company could make the investment, and because the company is making the investment, when they say, hey, what is the withholding tax rate? You're going to say, oh, well, it's to a UK company, therefore the withholding tax rate is going to be based on the tax treaty, and we're going to knock this down from 30% down to 5%. Let's just say, for instance, you were from Malaysia. Okay, so Malaysia, not having a tax treaty with the US, would be normally subject to the high tax rate, right? But you say, okay, hang on, I'm going to form this company in a country where there's a tax treaty and I have a 5% withholding tax rate. I've dropped it down. Great, look at me. This is wonderful, right? Not necessarily. So this was the way that it would happen, years ago. I'm trying to think about when they started to really bring in anti-treaty shopping rules. But anyway, for some period of time, you could take advantage of this. And generally what happens in the world of international tax is that they come up with rules, tax planners come up with some ways around those rules, then they make rules to try and counteract the tax planners, and it's a game of cat and mouse, right? Perfectly fine, perfectly reasonable. Well, they brought in anti-treaty shopping rules. Okay, so treaty shopping, to define what is treaty shopping, right? Treaty shopping is the process of going basically shopping for the country that's going to give you the best withholding rate. And you can, in theory, start layering these companies, right? So I'll give you an example of this. Let's say that you're like, okay, great, I want to bring money into this country at a reduced rate, right? But that country maybe, so let's just say, for instance, that it was France, okay? I don't know, we don't use France for these sorts of things, but let's just say that it was, right? I'm going to kind of show you why this would be. So let's say you can bring the money into France at this reduced rate. You're like, okay, perfect, great, I've got this money into France. Well, the problem is, if I pay it out from France, now I'm going to pay a higher withholding, I'm going to have a withholding tax rate, right? So then maybe I would say, well, hang on, what I'll do is I'll send it from France to another country that's in the EU, because then you have the EU parent subsidiary directive and I won't have any withholding taxes. And then but that one won't have any withholding taxes. So let's say, for instance, I don't know, you go from France to Cyprus. Now, it would make no sense to do this because Cyprus already has a tax treaty with the US, but I'm just kind of to show you this map of how this would work, right? So it goes from here, reduced withholding tax rate, no withholding tax, and then no withholding tax to you, right? So you could build this chain of entities that would reduce your withholding tax down to as low as possible, right? That would be the idea. So to deal with this, they started putting in tax treaties and then applied more broadly in some unilateral treaties, etc., these anti-treaty shopping regimes. And basically how this works is if you don't actually have substance in that country, right? If the purpose of what you're doing, you're just kind of throwing a shell company out there, they're going to deny you the treaty benefits, okay? That's pretty much the long and the short of it. So where this comes into play is when you're designing a corporate structure, you really want to be cognizant, and I've talked about this over a while now, of where you can build substance, okay? You want to not just be able to say, oh, I'm just going to form a company here and pay low tax. I get people all the time who are thinking, oh, I'm in XYZ country, let me just form in this other country that has a lower tax rate. Well, that's not going to work, okay? There's reasons that you have to have some substance behind that. And the moment you start building substance in, then you start thinking, well, hang on a minute. If I'm building substance, maybe I'm increasing a bunch of costs. So let's use an example of this. Say you had Isle of Man. You're like, okay, Isle of Man, no tax, wonderful. But you're like, oh, hey, but to hire people there is really expensive, right? I'm paying in pounds. There's a limited labor market, etc. So as we design these, we want to think, okay, what are my tax rates? What are my withholding tax rates based on the income that I'm getting? How do I make sure that that place also has, a low-cost labor pool, low cost of operating my business? It's relatively easy. I can get good banking, etc., and go from there. So anyway, bottom line of this whole thing, what is treaty shopping? Treaty shopping is basically picking and choosing the country to form based on trying to get a reduced withholding tax rate and benefiting from that tax treaty, but without having actual substance there. They've brought in some cases, it's not all, but there's like limitations on benefits clauses and things like this that are designed to be anti-treaty shopping to prevent you from doing that. And loosely speaking, you can go case by case and see what it is, but loosely speaking, this means if you don't have real substance there, we're going to deny you these benefits. So you want to have real business activity there, which changes your whole structure, right? And if you do that, then in theory, you could string together a variety of companies. So this is an advantage. The bigger you get, the more you can afford to have staff in 5 different places and, flow money accordingly. So anyway, I hope that helps you. It's, topic that's probably not that interesting for a bunch of people, but, want to appreciate you guys for reaching out and asking questions. If you have a comment that you would like to see a question answered or something like that, please put it in the link below. And if you haven't already, please hit the subscribe button. If you're interested in this subject, if you'd like some help with your structuring, please reach out to us. You can book a call, cardio.fm/Michael Rosmer, the link below. And I'm going to see you guys on the next video.